Hello, everybody, and welcome back. We're going to do another individual stock review today. Before we get into the individual stock, let's just rehash the valuation of stocks. A stock's current price reflects all available knowledge and prices in future prospects. Price is a function of future earnings and cash flow coupled with current income, which are dividends, and a multiple being paid on that stock, which is valuation. Fundamentals in each particular business will change over time. Most stock movements in the short term reflect a change in multiple based on sentiment, positioning, events, and news. Valuation in the long run, I think 5 to 10 years, is the biggest driver of excess returns. So today we're going to talk about Walgreens. Walgreens is the second largest pharmacy behind CVS in the United States. They have nearly 13,000 stores, about 9,000 in the United States, and the other 4,000 are international. As of 2021, 78% of the U.S. population lives within 5 miles of a Walgreens. That's quite a bit. I'm sure anybody that's listening to this can attest there's a Walgreens pretty close to where they live. 62%, so if you look at the breakdown of how they make their money, 62% of the revenue of Walgreens is through their pharmacy. 26% is retail. So let's think about retail as if you go in, you're going to pick up a prescription and you decide that you're going to buy toilet paper or shampoo or toothpaste or a toothbrush, something that's inside the store. Sometimes people buy greeting cards or Halloween candy. There's a lot of different things inside a pharmacy that is purchased. Additionally, there's another 12% that is wholesale, and this is actually probably one of their best, most successful moves in the last several years, where they did a joint venture with McKesson, and they're doing the majority of this wholesale pharmaceuticals in Europe. Additionally, they have increased the dividend for 47 straight years. Currently, the yield on the shares is around 8%, and the multiple, the PE multiple on earnings, is just 6.5. Pretty interesting, because if you just look at it relative to the yield, you're actually paying a lower multiple than the actual yield on the stock. Not that it necessarily means anything, but it does tell you that this company is dirt cheap. And lastly, there was a recent change in the CEO, and we think that that could be a turning point in the company, and we'll discuss that in a little bit. Now, why is Walgreens trading at a multiple of 6.5? Now, we talked about Newmont Mining and cyclicality of earnings on a different video. Now, Walgreens, which this is a very, very stable company, and we'll see that in a little bit, they have, so their multiple shouldn't be low because of cyclicality in their earnings. There has to be something negative with the story. And there have been a few negative things that have come across over the last several years. The first is they've had to make several large opioid settlement payments. They're not the only ones. There's been others, obviously CVS, Rite Aid, Walmart, any of the pharmaceutical manufacturers that were participating in putting out these opiate drugs, which has caused a big problem here in the United States. Next, and this is probably the biggest reason that their multiple is lower, is there is competition from Amazon with online pharmacy. Now, it's interesting to note on a few different things. It's not as if Walgreens and CVS have not had competition in the past. In fact, there was times when Walmart and Target actually left the business. They actually sold it back to CVS. But Walmart, Target, and you can even go to local grocery stores that have pharmacies within there. There is competition that has been around for a while. Additionally, when you look at Amazon and another similar space, a few years ago when they purchased Whole Foods, that was supposed to be the death of a lot of supermarket stores. And that actually ended up being the bottom. And you still see, even though Amazon is running Whole Foods, they are having competition. The other supermarkets, they simply have not gone out of business. In fact, they still continue to be there, and they still continue to do okay. Next, they have struggled with some poor mergers and acquisitions decisions, investments, and poor decision making in the past. And that has led to frequent turnover in the executive suite. So they've had quite a few CEOs over the last 15 years, 15 to 20 years. And that can be a problem because without a consistent leadership and consistent vision, it's very difficult for a company to continually perform well. So there are negatives. There's a reason why the multiple is low. We happen to believe that that multiple is a little bit too low. So here's one of the things you want to look at when we look at financials. And this is why I think this is important. When you look at the orange slash brown line, this is revenue. And you can see that prior to 2015, it was fairly steady. Obviously, there's some ups and downs. This is quarterly. It's a little bit of seasonality here. That's why it goes up and down, but it's pretty consistent as it moves up. Then you see the big jump here. That's actually a merger with Boots Alliance. That's why you see the big jump. And then it comes, and it's been fairly steady from 2015 all the way to 2023. But there is a bit more variability, and you can see the drop here. It's kind of stalled for a few years, even though we're sitting at record high revenue. Now, why is this important? Because we talk about multiples. We talked about this with some of the other cyclical companies where you can have earnings where you're making $4 a share one year, and the next year you're having negative earnings. You deserve a lower multiple. Because of the business that Walgreens is in, no, they're not going to make huge growth, but they're also going to be relatively stable regardless of what happens with the economy. In fact, if you just look at the revenue here, you can't pick out, if you took these dates out at the bottom, you would not be able to pick out where 2008 was as far as revenue is concerned. And for that reason, typically a staple company is going to have a much higher multiple simply because they have less variability in earnings. Now, if you look at it, this white line is actually the share price of Walgreens, and you can see it was up, it came down, it spiked, went significantly higher, and it's basically been a straight shot down since early 2015. Just so happens to coincide with around where this merger was. So again, we talk about good and poor management decisions. I would say this was a pretty poor one right here. But what's interesting is if you look at this, you have a company that share price is lower than where it was at the bottom of 2008, the great financial crisis, and you've got revenue that's almost 3 times higher. And the sole reason for that is the multiple is contracted pretty significantly, and we'll talk about that. If you look at these numbers, 80 versus 20 something, we'll talk about those numbers in a little bit. But that is strictly a function of multiple, what people are perceiving and willing to pay for those shares. Whether it's right, wrong, or indifferent, that's the way things are priced. So it's kind of interesting that at this point right now, you have a price that's lower than where it was, and you've got over 3 times the amount of revenue as where it was 15 years ago. So the next thing we're going to talk about is actually cash flow, because this is one of the most important things when you're looking at the sustainability of a dividend. And now this is just a snapshot of the last few years, and you can see net income in 2020 was actually much lower. That makes sense, but you can kind of throw that out the window because that was a one-time thing. 2021 started to come back. And you can see 2022, you actually had record highs as well. What's important is, there's a lot of things that go into net income calculation. There's a lot of accounting, but when you're looking at a dividend, you really want to focus on cash flow. And so the first thing you want to look at is cash from operating activities. And you can see this is fairly consistent, 5.5 billion, 5.5 billion, 5.5 billion for the last several years. And then it actually drops in 2022. And this is almost exclusively can be taken out of the opiate settlements, which we just talked about. Now, why is that important? Because this is a settlement like that is typically a one-time charge. Now, I know there's been several different states where it's gone through, but they're not going to have to pay these settlements in perpetuity, and it really has nothing to do with the operation of the company. And so you can basically take that out. Um, it it obviously affects them, but it's not something that's going to continue to affect them going forward. So I would expect this cash flow number to come back up to in the mid $5 billion range. Now, why is that important? Because when you look at the dividend, so dividends paid have been 1.7, 1.7, 1.6, 1.7, 1.6, 1.6. So you've got over 4 times coverage in cash flow from operations relative to where the dividend is. So there is significant coverage to support that 8% dividend, and you have very, very low variability in earnings. Does that mean that Walgreens will not cut their dividend? No, not necessarily, because again, you have a new CEO that's coming in, and if the new CEO basically says, listen, I need to get things right moving forward, I'll take my hit now, there's a possibility, even though they don't have to, that they could cut their dividend and create some investments to try to get some growth moving forward. That is always a possibility. But again, when you're looking at it, they've been through how many CEOs? I think they've been through 6 over the last 15 years, or 15 to 20 years, and they have 47-year history of cutting the dividend. It's going to be very difficult for the board of directors to approve that, even if they don't grow that dividend moving forward. Additionally, just while we're here, this financing activities, debt is a real concern when you look at companies right now, especially because the cost of debt with interest rates going up, if they have to refinance it, it could become a problem at some point in time. Now, you could see this is pretty consistent, and I'll just look at this. So this is cash from long-term debt. So if you issue long-term debt and then repayments of long-term debt, and you could see that those numbers line up pretty closely every single year, other than this is 2021, and all that basically is, and I explain this a lot to people, is companies don't typically pay off debt through earnings. They usually pay off debt by refinancing. And that becomes a problem when interest rates go up. So for instance, if you took a $2 billion bond that is due in 2024, you're not paying that off as you go along. You basically run your company as it is, and when it comes due in 2024, you issue new debt at $2 billion and whatever the going interest rate is. Now, they have a lot of maturities that come through all the different years, so it's not like they're going to get hit with everything all at once, and they do have a significant amount of cash that it's not completely necessary. So there are risks, but you can see that it's pretty consistent that they've been issuing new debt to basically pay off their old debt as they go, and that's something to monitor going forward. But again, for this company, it doesn't significantly impair the cash flow or their dividends. So one of the things that I want to mention here again is something that's interesting, because you can see that dividends paid have been fairly consistent and actually dropped slightly in a couple of the years. And how can that be the case when they've raised their dividend for 47 consecutive years? Well, it's simple, because if you are buying back shares, if there's less shares available, so you take some of your other excess cash and you buy back shares, then you can raise your dividend and actually pay less cash out. So just an example, if you have 1 million shares out and you're paying $1 a share, then you're going to pay out $1 million worth of dividends. If you buy back 500,000 shares and you pay $1.50 in dividends going forward, you actually raise your dividend by 50 cents or 50%, but you're still going to pay $1 million out in dividends, because now you have less shares to pay them on. And that's basically how it works out. And you can see this is just an example of the use of cash from Walgreens. And you can see they actually, in 2019 and 2020, they actually bought back a lot of shares. And then they started to conserve their cash the last couple of years. So again, was that the right thing to do? Should they have bought back shares? Considering the share price is now half of what it was back here? Probably not. Maybe they should have invested in other things, but that's just one of the few things that you can do with that excess cash. You can pay dividends, you can buy back shares, you can invest for future growth. And that's something I think we'll see with the new CEO. So we're going to talk a little bit about that. There's a lot of things that you can do with the numbers. It's obviously undervalued, but where do they go moving forward? Again, one of the things we talked about with stocks is they are forward looking. So here's a description of, and you can look at this. I'm not going to read through everything here, but the most recently departed CEO that was there for a few years. She worked at Kimberly-Clark, Walmart, and Starbucks. Walmart and Walgreens are somewhat similar, but this is a lot more retail oriented. Kimberly-Clark, Walmart, Starbucks, a lot more retail oriented than what Walgreens is. When you've got, again, let's go back to the other slide, when 62% of your business is in pharmacy and you have no pharmacy experience, it may not necessarily work out, which is exactly what happened over the last couple of years. Now let's go to the new CEO, Tim Wentworth. He has extensive experience in pharmacy and benefit management space and also has entrepreneurial experience. I'm just going to make a few highlights. Most recently, he was the founding CEO of Evernorth, which is Cigna's health services organization. They deal with health plans, employers, government organizations. They deal with pharmacy solutions and benefit management. This is exactly what Walgreens has been lacking. It's exactly why Walgreens has lagged CVS, and I think this makes it a good hire. Prior to Cigna, he was the CEO of Express Scripts, which was the largest pharmacy benefit management manager in the United States. The company, he sold that. It merged with Medco Health Solutions. This is something, so he's brought something full circle. He's gained value and sold it. This is important for a CEO, especially one that's in space. This is what I find interesting, right? Because this is not, you think of pharmacy, you think of these types of things as not very, they're not creative. They're not innovative. This is just old school, very boring. Now let's read this sentence. He grew Medco into a Fortune 22 company, 100 billion in revenue, 26,000 employees, ranking number 66 on Forbes magazine's list of world's most innovative companies. That's what I think is very important. He was innovative in a space that's not very innovative. That's something that I think that they will benefit from. And I'm not going to go into the rest of this, but he has extensive experience in the space, has had success in the space as well. And I think this could be a good hire for Walgreens, especially when you take on that valuation. So where can we see Walgreens going? Previous to 2017, Walgreens averaged a 20 multiple to earnings, and it has steadily declined since then. At a 20 multiple, this would imply an $80 a share price next year. Now, given the negatives that we talked about, we do believe that Walgreens should trade at a discount because there are some uncertainties until they can get this ship righted. Now, a 40% discount, which is a significant discount to the market, and I don't know that it should even be that much of a discount. The current market multiple is 23.5. That would be around 14 times earnings, would imply a price of 56. So let's take it one step further. Even at 10 times earnings, which is where it's traded over the last several years at a very depressed valuation, that would imply a price of $40, which is still 68% higher than the current price. You couple that with an 8% dividend, there is a lot of negatives already built into this stock. There's a lot of potential for this to surprise to the upside. And even if it just got back to an average multiple, you're talking about a share price that can more than double. So those are the reasons why we like the company. There are some negatives in the stock, but as you can see, that has already been priced in, and we think that this is a good entry point.